In this video, I'm going to show you how to calculate the amount of goodwill recognized when Amazon.com bought the company Ring. So in the second quarter of 2018, on April 12th, Amazon purchased this company Ring, and they paid $853 million net of cash acquired. Net of cash acquired means this: if you pay $1,000 for a company, but that company already had $50 cash, you're really only paying $950 cash because you're getting the $50 of cash that company had. That explains why, if you look in the media, sometimes they would say, oh, Amazon paid $1 billion or more for Ring. And so you might say, well, why is it that in Amazon's 10Q, their quarterly report, that they're disclosing they paid $853 million? And that's the reason for the discrepancy. Ring had some cash already, and so when Amazon acquired Ring, they got access to that cash. After netting out that cash that Ring had, Amazon ended up paying $853 million according to their 10Q. Okay, and so what Ring does is they make a smart doorbell. They were actually featured on the television show Shark Tank, where they were trying to get a deal, and they did not get a deal from the Shark Tank investors, but they had other people who invested, and then ended up Amazon buying this company on April 12th. And so basically you could see why Amazon might be interested in this, because this smart doorbell basically takes a video, and people can look on a video and see, oh, who is this that's at my door, and potentially let them in the home and stuff for packages being delivered. So you can see where there's some synergies here with a company like Amazon, which obviously consumers buy a lot of packages that are delivered from Amazon or carriers that are associated with Amazon and so forth. Okay, now, this purchase price that for Ring, we're going to see a little bit of discrepancy in the 10Q because Amazon also purchased some other companies during 2018. And so when we look at the purchase price for that's going to be used to calculate goodwill, because ultimately to figure out the goodwill, we're going to take the purchase price and then we're going to subtract the fair value of net identifiable assets. I know that's a mouthful. Don't worry. I'm going to get to that. I'm going to show you equations of how to do it. But this purchase price is going to be important. But it says 892, and this is in millions, by the way, so that's $892 million. But you might be thinking, hey, wait a minute. We just saw that Amazon said $853 million. Well, the $853 was for Ring, but there was another $39 million for other companies. And Amazon doesn't break it out in their 10Q into the specifics. They're just going to have the assets for all of them and so forth. So a small portion of what we're about to talk about, the assets and liabilities, doesn't pertain to Ring. It pertains to other companies. But obviously the biggest acquisition here, $853 million out of the 892, pertains to Ring. Okay. Now, also, you're going to see that, so when the 892 is the purchase price. That's the amount that Amazon paid for its acquisitions during this quarter. But you're going to see, well, they paid $865 million cash. What's this $27 million? You might be wondering about this indemnification holdback. I'll make another video just specifically on indemnification holdbacks because there are multiple reasons why a company might do that, and Amazon didn't give us details of what this pertained to, but I'll just give you an example of how this might work. So hypothetically, Amazon could have said, well, we have some disagreement with Ring about what should be the price of the acquisition, and maybe Ring wants more money than what we think. And so then Amazon says, well, I'll tell you what, we'll take $27 million and we'll set it aside in an escrow account. And if you meet certain earnings targets, so if Ring has a certain profitability next year, if you meet a certain target that Ring's owner is saying, yeah, we can hit that target, then we'll take the money out of the escrow account and you'll get that. So it's part of the purchase price provided that Ring hits those targets. There's other reasons that there could be an indemnification holdback, but I don't want to get too lost in the details on that. We'll make another video. Now, whenever you have an acquisition, you're trying to figure out goodwill, you need to be able to figure out the fair value of the net identifiable assets. Okay, and so to do that, you're going to need to know the fair value of the identifiable assets. When I say identifiable, I mean anything other than goodwill. So what happens here is that people at Amazon, maybe they bring in a valuation expert or someone specialized in M&A, and they say, okay, what are Ring's assets? Okay, and then again, remember, there's a few companies in there other than Ring, but mostly we're talking about Ring. What are their assets? And they say, well, we've got three types of intangible assets here. We have marketing-related intangible assets, which the fair value is determined to be $141 million. And then marketing related intangible assets, by the way, are things like the trademark, the domain name. So Ring actually owns ring.com. They paid a lot of money for that. And so you think that'd be a very popular domain name. And so that fair value of ring.com is included in these marketing related intangible assets. Okay, Ring's trademark and so forth. That's what's meant by marketing related intangible assets. Again, now Amazon doesn't break it out and say how does this 141 million, how much is domain names, whatever. It doesn't tell us that in the 10Q. Now, there's also some technology-based intangible assets. Generally speaking, those pertain to patents, but there also might be like trade secrets. You think about Coca-Cola's formula and stuff, but basically it's patents it's referring to. You can patent a product or you can patent a process. Now, there's also some customer-related intangible assets. The fair value, 140 million, and that's usually a customer list. So Ring has a bunch of customers, and they have probably email addresses and so forth, people who signed up. And so that has value to Amazon. Amazon could look at that customer list and potentially market products to them. And so if you add up these three types of intangible assets, there's a fair value is deemed to be $446 million of those assets. Okay, so we got $446 million in intangibles. Then we've got property, plant, and equipment is only $3 million. It makes sense, right? This is a small company. Really, they've got a technology that they've developed here, and so that's the real value. So we don't expect a bunch of machinery and so forth. So $3 million in PP&E. There's $106 million in deferred tax assets, and then there's some other assets. It doesn't tell us what they are. $254 million. Okay, so those are all the assets. But when we do the fair value of net identifiable assets, we're going to take the fair value of all these assets, we're going to add it up, and then we're going to subtract the fair value of the liabilities. And the liabilities here, we've got $97 million in long-term debt, $106 million in deferred tax liabilities, and $321 million in other liabilities. We're not told what they are. Okay, now we get to our formula I was telling you about. So fair value of net identifiable assets, we're going to take the fair value of the identifiable assets. So that's these right here. These are the identifiable assets. This is the fair value. Fair value identifiable assets. We're just going to add those up, and then we're going to subtract the fair value of the liabilities. So here's the liabilities. Okay, so that's where we're going to get the net assets. Okay, so all we do, this here is just me summing these together. Okay, and then here we've got the liabilities summed together. And so we just subtract the liability. This is $524 million. And then this here is $809 million. And when we subtract the liabilities from the assets, we get $285 million. So what is that saying? It's saying if we take Ring and these other companies that were acquired as well, and we say, okay, after subtracting the liabilities, what is really the fair value of the identifiable assets here? If we just parted out the assets of Ring, say it's $285 million. Now we have to compare that to the purchase price. We're going to take this $285 million and compare it to the purchase price. What was paid? And we remember that was $892 million. Remember, we include that indemnification holdback. So Amazon paid $892 million. But the fair value, if we were to part it out and parcel it out and look at each asset and then subtract the liabilities, this company is $285 million of assets after subtracting the debt. And so there's 607 left over. So you can think of it as that Amazon paid more than the fair value of the net assets. Why? Well, because it's believed that the assets working together as a unit are worth more than just the if you parted out the customer list and you parted out the PP&E. All the assets working together have more value than on an individual basis. Okay, so we paid more than the fair value of the net identifiable assets, so we're going to record goodwill. We're going to record goodwill, and so we're going to record $607 million. Remember, this is in millions. Don't get caught up. So this is 607, but it's $607 million of goodwill that was recorded, mostly due to Ring, but again, there were other transactions as well. Now, this goodwill is going to be an asset. It's going to appear on the balance sheet. Now, if you look at their balance sheet, it's not necessarily going to say $607 million because in prior years they acquired other companies and had goodwill. This is just pertaining to the goodwill recognized or incurred or purchased this period. Okay, so this is going to be an asset. Now, in the future, for financial reporting purposes, so we're talking about the financial statements, disclose the SEC and so forth, 10Q, 10K, we're not going to amortize goodwill. Goodwill is not amortized, and but it could become impaired. Okay, it could become impaired, and I'll make another video on impairments, and I'll find a company that has actually taken a goodwill impairment and so. But basically, when you think of like if the value of Ring were to drop, and so we say, well, the fair value of Ring as an entire business unit, let's say that decreased below the carrying value, which is the value, the amount on the balance sheet for the investment in Ring. If that were to the fair value of Ring were to drop below the amount that's on the balance sheet, then we could have a situation where we'd impair some of the goodwill. But again, I'll talk about that in videos to come.